Did you know that having a smaller account actually mathematically increases your chance of failure when it comes to the stock market? And in a lot of these cases, it's really because of position sizing, because you're not able to allocate or spread your money out properly, not in the way that you can with a larger account. Let's say you're looking at spreading your capital or just spreading out some money. What I've got here is from a previous video, we've got a few different positions that we could spread out capital. And what many people do is they go in, they might do, 600 shares on Pinterest, a little bit on Tesla, a little on Apple, and a little bit on Netflix. However, the issue with this is when you start getting into, let's say, 400 shares of Tesla, it starts to add up just because you have to pay up quite a bit of money. So here we've got Tesla that's powering higher at 242, but when we start looking at constructing this portfolio, so here's our stock price at 242, and we go in and we multiply this times, let's say 500 shares, we're actually looking at around $121,000 for the position. So the problem with this is that now you've got to have a large account to be able to do this. Now let me go in and convert this to a little bit more of 100 shares, and now we can go this column times this column. If you even do 100 shares, you're looking at $24,000 on this position. So when we look at doing a construction on position sizing, you have to be very careful that the stock that you trade doesn't over exceed the amount in order to spread your money and spread your capital. Because even if you get a stock that's $120 a share, you're still looking at $12,000. And the problem with that is if you go with another $120 stock and you get another 100 shares, and we'll fill this in. Now what we're doing is another $12,000. Now, if we calculate kind of the sum of this, we're up to $24,000. So what we've really ended up doing is combining and constructing this portfolio into two positions. If we've got a $25,000 account, I've spread my risk amongst two positions, and that's not really spreading out capital or risk. Because if one position goes down, or let's say we lose it, a $25,000 account gets cut in half. And that's a big issue, and that's a big problem. So unfortunately, with small accounts, you do have that problem where you can't spread things properly. Even at 1% of $25,000, so let's say we take this times a 1% amount, you're looking to spread capital amongst $240. Now, which stock can you buy with $240? And maybe 10 shares, 20 shares, 50 shares. You have to go in and really be disciplined to be able to start spreading money and spreading capital. Now, you might say you have a stop in place, and all that sounds good, but there are things like gap downs and things happen in the marketplace that you can't foresee. So the one way to do this is to minimize these things through option trades, trading $250, $250, $250. And this is where you can actually spread money. But most people are not that disciplined. Instead, when they look at spreading capital, even on a position of, let's say this Tesla stock, and we're spreading money amongst a $5 wide, it'll cost us about $250 on a vertical. So there it is, $250. If we confirm and send, you'll see the cost is right around $242. So when we look at this, even then, we can only do one contract. That also means we can't peel things off into strength. So it becomes a little bit of a problem spreading money. Now, yes, you could go in and spread $250 and then $250, and then we can continue to fill this. And now we're spreading money in different spots, and we've got stock number 1 and 2. And this is where things start getting a little bit better, because now you've got a lot of stock positions in different zones in different areas. But the issue is that when we start going into all of this, it takes a lot more work. And most people aren't willing to do this because they're not looking to spread out capital. So think about it. When you're starting to spread out $25,000, how many positions are you really looking at to be able to spread this out to $25,000. Even at 10 positions, you're still only at 2,500. So if we continue to spread this even further, we start going even more. Take a look. We've got more and more positions, but even then, it's still only at 3,750. So it becomes more difficult to start spreading capital when you have a smaller account. Now, spreading capital with larger accounts are also tough. because you need to figure out where to hide the money. But look at all these positions. I have to have 64 positions to spread out capital properly if I'm doing vertical spreads. So that's a ton of positions. Now, when you start looking at, let's say, the types of trades I'm doing, or just looking at a bunch of positions, now you could do it if you're okay and dealing and managing with a bunch of accounts and good with let's say just looking at your portfolio. But look, I've got a ton of here positions, and if you start opening them up, there's more stuff in each one of these as well. So we've got positions. I've got more positions here, and this is just a paper account. And then I've got probably, I don't have any positions there on that other one, but either way, we've got a lot of positions here that are spread out. So my point here is that when you're dealing with a smaller account, if you concentrate your risk and you only got 2 positions, it really becomes a big problem because you're over allocating in one spot. So what this does and creates is a mathematical problem where your concentration of risk is so heavy on a percentage basis that if that stock actually does fall to a problem level, it's going to be tough to recover those losses from this position. So you have to go trade another stock, and then you have to make that up, and that becomes more and more difficult. So in order for you to properly allocate and spread money, you have to do it in bite-sized pieces, which most people are not disciplined enough to do because it takes a lot of work, it takes a lot of energy. Most people want things easy, but this is the more appropriate way. As you get into larger account sizes, it becomes easier because, well, now you could concentrate some risk in different spots and spread your money in other ways. But when you're trading with a smaller account, you've really got to look at spreading capital and position. Otherwise, you're going to concentrate your risk. Or the other thing that people do is they'll put in, like, let's say $3,000 on one vertical, then they'll do $2,500 on another vertical. And then what they'll do is maybe let's get rid of this. They'll do another 5,000 on another stock, 2,000 on another stock. And now by the time we've gotten 3 or 4 positions, we've got 12,500. So that's half of our positions, and we still only have 4 positions. That allocates it quite a bit even then, because you only got 4 positions. That's 20. Each one is kind of concentrating about 25%, relatively speaking, but they're not all equal, right? This 5,000 is a little bit larger, but you're still concentrating in just a few spots. And this is the bigger issue with smaller accounts, is that you know, with the stock market, because it's big and you're buying up shares, or you're buying options, or you're selling options, the amount of capital there that it takes out of your account is quite significant, and therefore unfortunately you're forced to put on larger position sizes than you want to or can deal with, because now you've got to concentrate risk there just to make kind of any kind of money. So this is what makes it difficult on these accounts when you have a smaller account. It's just something to be aware of. I'm not saying you got to start with a large account, because you don't, but you have to recognize that it's with a small account, especially at $5,000, those levels will make it difficult to grow that account. It makes it difficult to spread the risks, to spread capital, because you have to concentrate your risk. And really, by concentrating your risk, you're at a disadvantage, and you're starting at a disadvantage to be able to be profitable and really avoid huge problems in the marketplace. So you've got to get things to go your way, a little bit of luck and maybe timing, but unfortunately, you're going to have to concentrate some of that risk in those zones. Otherwise, it's tough to kind of get out of it. Once you start building into like $50,000, $70,000, you can start allocating into a few different stocks. But even then, if you're doing covered call strategy with a few positions, it still makes it difficult, because now you've got stocks that actually will have some premium. And let's say you're dealing with an $80 stock, you get 100 shares, that's $8,000. And maybe you've got a $50,000 account, you still can only deal with 5 positions. That still concentrates your risk quite heavily. So be mindful that when you're doing these things, it does make it difficult to kind of get out of that situation and build and grow that account, because it's tough. So I just want to give you a little insight here on small account things, because it's one thing to watch out for as you start trading and developing things further. That position sizing and concentrating your risk is quite a big issue with smaller accounts. Anyways, good luck to you. Feel free to reach out, check out the Traders Fly website, and check out some of the more courses, materials, and freebies that we have there that you could download. Anyways, I'll see you in the next video. Take care.